The power. Nobody elected. You've heard of Apple. You've heard of Google. But there's a company that owns pieces of them all. A company that doesn't make cars, phones, or movies, yet quietly manages more money than any nation on earth. It's not a government. It's not a family dynasty. It's a machine that moves capital. A global investment manager overseeing over $10 trillion, an amount greater than the GDPs of Japan and Germany combined. Yet few can explain what it actually does. In this story, we'll uncover how one man's failure turned into an empire that changed how global markets operate forever. This is Orlando Finance, and this is the story of Blackrock, the invisible empire that controls the world's money. Chapter 1. Failure that built a giant, 1986-1988. In 1986, a young bond trader named Larry Fink was living the American financial dream. At 33, he was a star at the investment bank First Boston. He specialized in a revolutionary product, mortgage-backed securities, bundles of home loans repackaged and sold as investments. It was new, exciting, and wildly profitable. But finance, like fire, burns the careless. When interest rates unexpectedly rose, Fink's models collapsed. In 1 week, his portfolio lost $100 million, his career gone, his reputation ruined. Yet that failure gave him the most valuable lesson in modern finance. The biggest risk in finance isn't losing money. It's not understanding where the risk actually is. Fink realized the system had no tools to measure risk. No visibility, no unified data. In 1988, he and 7 colleagues walked away from Wall Street's chaos. With $5 million from the private equity firm Blackstone, they founded Blackrock. Their mission wasn't to gamble with markets, it was to understand them. Chapter 2. Aladdin. The machine that never sleeps in a small New York office, the team built something extraordinary, a computer system capable of mapping every investment and every chain reaction. They called it Aladdin, Asset, Liability, Debt, and Derivative Investment Network. It could model how a change in interest rates might ripple across portfolios, banks, and even countries. Aladdin didn't predict the future, it simulated it. And in finance, simulation means control. By combining quantitative models, historical data, and real-time analytics, Aladdin could reveal risks before they became disasters. It was the first true risk management platform in finance. While others relied on instinct, Fink relied on math. By the early 1990s, major pension funds, insurance companies, and even rival banks began using Aladdin. They weren't just investing, they were outsourcing their risk analysis to Blackrock. The company wasn't just growing, it was embedding itself into the nervous system of global finance. But success brought conflict. Blackrock was still owned by Blackstone, the private equity empire led by Stephen Schwarzman. Schwarzman focused on private deals, buying and selling companies. Fink wanted transparency, public markets, and technology. Their philosophies clashed. In 1994, they split. Blackrock kept its name and independence but lost its backer. It was risky. Yet, Fink knew independence was worth any price. That same year, global bond markets crashed again and Blackrock's models helped clients survive the chaos. Word spread, this wasn't luck, it was engineering. Chapter 4. Data before the world understood it. As the new millennium began, Blackrock had something Wall Street didn't: information clarity. It went public in 1999, raising $375 million. Investors saw it not as an asset manager, but as a financial technology firm. Aladdin became the gold standard for risk management. Even competitors licensed it, giving Blackrock access to their portfolio's internal data. By 2007, Aladdin was monitoring $7 trillion in assets across more than 100 institutions. In effect, Blackrock had built a digital map of global finance, and it didn't even own most of it. And then, everything changed. Chapter 5. The 2008 Financial Crisis. 2008-2010. In 2008, the financial system imploded. Subprime mortgage bonds, the very invention Larry Fink helped pioneer, brought the world to its knees. Banks didn't know how much toxic debt they held. Governments had no way to calculate the damage, but one company did: Blackrock. Aladdin could trace exposures, who owed whom, where the losses were, and how to unwind them. The US Treasury called Fink. Blackrock was hired to help manage the failed portfolios of AIG, Bear Stearns, Fannie Mae, and Freddie Mac. The irony was complete. The man once destroyed by interest rate risk was now rescuing the global system from it. In 2009, BlackRock acquired Barclays Global Investors, including iShares, the world's largest ETF platform. Overnight, BlackRock's assets tripled. A small startup had become the largest asset manager on Earth. Chapter 6: The Age of ETFs, 2010-2016. In the 2010s, investing changed forever. The rise of ETFs, or exchange-traded funds, allowed anyone to buy a slice of entire markets in one trade. Instead of picking individual stocks, investors could own the whole index. Cheap, efficient, automated. For long-term savers and pensions, this was revolutionary. And who controlled the ETF revolution? BlackRock's iShares. Every month, millions of automatic contributions from retirement accounts flowed into iShares ETFs. It was passive investing, but the profits were very active. By 2015, BlackRock managed $4.5 trillion. Today, that figure exceeds $10 trillion. But this success created a paradox. The more people invested passively through BlackRock, the more influence BlackRock gained over the companies inside those funds. By the late 2010s, regulators and critics began asking a dangerous question: is BlackRock too big to fail? Through its ETFs and index funds, BlackRock became a top shareholder in most major corporations: Apple, Microsoft, Exxon, Pfizer, Amazon, and even rival banks. It held voting rights that could influence corporate strategy, climate policy, and CEO pay. Yet, it didn't technically own these companies. It just represented investors. This gray zone gave BlackRock enormous soft power without legal accountability. In 2020, when COVID-19 shattered global markets, the US Federal Reserve again called BlackRock to manage its emergency bond buying programs. A private company was now helping run public monetary policy. Chapter 8: The ESG Revolution and Backlash, 2020-2023. As BlackRock's influence grew, so did expectations. Fink began urging CEOs to focus on ESG, environmental, social, and governance issues. He argued that sustainable companies would outperform over time. His annual letter to CEOs became a global event, read by politicians, boards, and media outlets. But ESG became a battlefield. Critics on the political right accused BlackRock of pushing woke capitalism. Environmentalists accused it of hypocrisy for still holding fossil fuel investments. Some U.S. states banned their pension funds from working with BlackRock.
I'm ashamed of the word ESG. It's been weaponized.
What began as moral leadership turned into political crossfire. BlackRock had become a symbol of both progress and power. Chapter 9: The Machine and the Future, 2023 Today. Today, BlackRock's greatest asset isn't money, it's data. The Aladdin system now processes simulations across 200 institutions, covering over $21 trillion in assets. It doesn't just manage portfolios, it models climate risk, supply chains, and geopolitical tension. Governments rely on it, so do competitors. And that raises a new question. When everyone depends on one system, what happens if it fails? Some fear Aladdin's influence has grown beyond control, a black box that even its creators can't fully audit. Others see it as a stabilizing force, a guardian keeping markets from self-destruction. In reality, it's both. A reflection of our dependence on data, automation, and algorithms to manage complexity. Chapter 10: The Lesson, the Empire of Information. Larry Fink once said, "We're long-term investors in a short-term world." His empire was built on that philosophy, seeing risk not as a fear, but as a system to be understood. From one man's $100 million mistake to a $10 trillion empire, BlackRock reshaped how money flows through the planet. Yet its story also warns us. When systems become too interconnected, even one miscalculation can ripple across humanity. The next great crisis may not come from greed or politics. It may come from an algorithm misreading reality. Blackrock is not a villain or a savior. It is a mirror, showing us the power and fragility of the modern world. And perhaps the lesson is this: to control risk is to understand it, but to understand it, you must first see it.